The topic that we'll be discussing today is the sale of complex financial products to retail investors and the related issues in terms of investor detriment. So first of all, what are we talking about? We will be talking about retail investors, and that's everybody except professional investors. That's you, me, your neighbor. So a retail investor is an individual that is not a professional in finance and that has some savings to invest. The European regulation makes a distinction between three types of investors: retail, professional, and counterparty. But professional and counterparty are essentially professionals in finance, and they are well equipped to make informed choices with their investments, whereas retail investors are not. It is therefore important to ensure that retail investors are protected from bad advice, misleading information, and products that are not suitable. There is indeed an incredible number and variety of financial products that you can invest in, from deposits and saving accounts to stocks, bonds, funds, life insurance contracts, and some others. And it is also extremely difficult to compare these products, as similar products can be packaged in different formats, such as a fund, an insurance, or a bond, but also because the information that you get is not the same for every product, is very lengthy and full of technical jargon, which makes it difficult to understand and compare the products. And finally, the financial products are not always designed to benefit the investor, but sometimes their design is complicated on purpose to enable the seller to take a bigger margin. So all these elements create a risk of mispurchase, which is when an investor purchases a product that is not what he thought it was, he has not understood the risk, and he is surprised when he incurs losses. So the issue here is really not whether an investor has lost some money or not, as an investor can choose to take some risk, and that's absolutely fine, but rather whether he understood when he purchased the investment product the related risk of losing money he was taking. So it's really about the investor not being surprised when he loses money. As Mathieu mentioned earlier, before joining Finance Watch, I used to manufacture and sell structured products for more than a decade to professional investors. And I have seen regularly how even professional investors can sometimes be fooled by the complex packaging of products and not fully understand the risks that they are taking. So why are we interested at Finance Watch? What are the issues, and where is the public interest dimension? Well, first of all, the financial crisis has evidenced a vast number of cases where investors lost money where they thought they had purchased safe investment products. There have been several mis-selling scandals where investors were sold products that were not suitable for them, or products with excessive fees disclosed in an unclear manner. And this has led to a general distrust of the financial industry from investors. And in fact, a recent study showed that amongst 50 sectors, consumer satisfaction was lowest in financial services. But not much has been done so far, except on a case-by-case basis to address these issues. And the current context of low interest rates provides a very fertile ground to sell complex products promising high returns, as investors are much more likely to listen to magic promises when the rates are low than when simple products offer a good return. So what about the public interest dimension here? Well, there are actually several public interest dimensions. First, investor protection. Are retail investors given the means to make informed, suitable investment decisions, which is, do they receive adequate information, genuine advice? Are they offered suitable financial products? The problem is that investment choices are key but very infrequent decisions in the life of an individual, and therefore there is unfortunately very little room to build experience from past mistakes without paying a high cost. And secondly, the second public interest dimension is political. The size of the European retail market is absolutely massive. In 2009, it was estimated only for packaged products to be around 9 trillion euros. And to put that figure in perspective, that is the combined GDP of France, Germany, the UK, and Belgium. So one could argue that it is important from a society point of view that these savings finance the real economy, that is, go to finance projects or companies that create jobs and growth. And in fact, that is nothing new, as most governments already use differential tax treatments to promote some types of investments that are seen as beneficial for society, such as life insurance. But one could argue that more could be done in that area, especially in the current context where European member states are heavily indebted and European companies need stable funding. On a related topic, one could argue that European citizens should be given the information enabling them to invest into socially responsible companies and projects if they wish to do so. Information is indeed the first step to education and to be able to make informed decisions. So this is not about imposing to everyone to invest into environmentally friendly, socially responsible companies. A lot of investors probably only care about their return, but as was recognized by the European Commission, a large proportion of investors also care about other elements, such as the environmental and social impact of companies that they invest in. And currently, they're not given the information enabling them to differentiate financial products. So just like food products disclose their fat and salt content, we would argue that financial products should disclose whether they're environmentally and socially responsible or not, to enable investors to make informed decisions on this topic. And finally, there is a systemic dimension, typically when financial advisors promote some investment products that contribute to creating bubbles. So why are we talking about it today? What is the context? Well, faced with a huge number of mis-selling scandals after the crisis, the European Commission was asked to examine the issue and come up with proposals to address it. And here is a typical example of mis-selling. This is actually a real example that happened a few months ago in some European member states. One bank offered its customers to move their savings from their deposit account to invest into a product that was called Contingent Convertible Bond issued by the bank. So what is it? Well, it's just a 10-year bond that was offering a very attractive rate of 4% the first years, and then a floating rate. And the bond had also one specific clause. If the bank capital declined below 5%, then the bond would automatically convert into shares of the banks. The customers were told that the rate was very attractive and that the product was almost as safe as a deposit account. Now, the bank capital declining below 5% means that the bank is in financial trouble. She probably lost some money on some investments or loans, and the losses have reduced its capital. Therefore, when the capital declines below the 5% level, it is very likely that the shares of the bank will have declined significantly as the market is concerned about the bank getting bankrupt. Therefore, when the bond converts into shares, the decline of the shares means an immediate loss for the investor. Say the investor invested €1,000 and the shares have declined by 30%. Well, the value of the investments when converted into share becomes €700. So for the bank, this was a very good deal. The bank paid some extra interest at the beginning, but then she could get some additional capital very cheaply whenever she ran into trouble. A bank would usually find it very difficult, and in any case very expensive, to find new investors and raise new capital when it is in trouble, as investors would ask for a huge return in exchange for the risk of the bank failing. In our example, probably more like 15%. So for the example, however, for the investor, this was not a good deal. First of all, most of them did not understand the risk that they were taking. The advice that they received was flawed, as the product was incredibly more risky than a deposit account. And finally, the return that they got for taking that risk was really poor, as the bank should have paid far more interest on such a product, but the bank played on the fact that its clients had no idea about the risk. And in our example, things were actually worse, as some unscrupulous salesmen convinced some of their clients to borrow in order to buy more of these products. And when the value of the investments collapsed, people were left to pay interest on their loans, but did not receive any more interest from their investment. So this is a typical example of mis-selling. And as a result of similar cases, the European Commission noted that the financial crisis has provided a stark reminder of the importance of transparency in financial products, and of responsible selling in institutional and retail sectors. The Commission also noted that asymmetries of information about investment products exist between retail investors and those designing the products and seeking to sell them, and retail investors are not thereby well equipped in protecting their own best interest. Such investors often face confusing and overly complex information about possible investments, where risk and cost of products are difficult to assess and compare. So the European Commission identified two areas where additional action was needed: financial advice and transparency of financial information. So the first area is in the process of being addressed through a European regulatory proposal called MiFID II. And the second one, through a regulatory proposal that is currently starting to be debated within the European institution called PRIPs. So what is PRIPs? So you can see on your screen essentially, I mean, it's a very summarized view of the range of investment products available. Basically, you have shares, bonds, saving accounts, funds, etc. Some investments are simple. You buy directly a share, a bond, and some others are packaged. And package means you invest indirectly and not directly into the securities. For example, you will invest in a fund that will buy shares, or you will buy an insurance contract that will invest in shares, etc. So packaged products are more complex to understand, and that's why the Commission decided to focus on improving the information for these products. So packaged product includes four categories of investment, essentially. The UCITS funds, which are investment funds that are subject to very strict guidelines in terms of risk management. That's the biggest share. You have non-UCITS funds, which is essentially also investment funds, similar to the previous ones, but they're not subject to the guidelines. So usually they are more risky. You have unit-linked insurance contracts, which are life insurance contracts that are invested into shares or bonds, and therefore whose value fluctuates with the financial market. So essentially, unit-linked are not very different from a fund. It's only that the legal format is different. And finally, you have retail structured products, which are financial products that are usually complex and whose return is based on a formula. These products are not funds, they're all securities like bonds, except with a complex risk and return profile. So these four categories constitute the so-called packaged product and are the scope of the current European Commission proposal. So what is the proposal of the Commission? Well, the Commission proposes to introduce a new information document for this product that must be short, around 2 pages, using very simple language and no technical jargon, and focusing on the key information on the product. And this document must be given to customers before they purchase the product. The idea here is really that current information documents are too long, nobody reads them, and they're too technical. So we need to make information more intelligible, which is a very good and long overdue initiative. So as the proposal is currently being debated, we do not know yet its exact final design, but essentially it should look pretty much like what you have on your screen. That's really an indicative document that we built based on the current proposal, but again, the final document might be slightly different. So first, the document will disclose what type of investment we're talking about, what are the objectives in terms of strategy, in terms of return. The objectives will also have to indicate whether or not the product targets specific environmental, social, or governance objectives. And it will also disclose indicative future performance scenarios. So we do not know the detail about these performance scenarios yet, as it hasn't been defined, but we assume that there will be 3 hypothetical scenarios, 1 bad, 1 medium, and 1 good, showing the possible returns at different points in time of the investment. So obviously these scenarios are indicative and the real returns will not reflect the scenarios, and possibly the investors might lose more than the bad scenario, but we find that they provide a good indication. They give a sense of whether the product is risky or not. For example, if by reading the text or listening to an advisor, you think that the product is low risk, but then you look at the scenario table and you see that you can lose 20%, yet, you know, that might raise a flag. You're like, oh, maybe I haven't really understood the product and the risk. I will not go into the detail of the whole document right now for lack of time. If you want to know all our comments on this design, you're very welcome to go and read our report. I will just focus on the dimensions that are really important for us right now. So essentially, what is good, what is bad, and what is missing in the Commission proposal. Well, the key concern for us is actually not what is in the document, as we find it's generally a pretty good document, but rather what is not in it. Well, first of all, effective investor protection requires a combination of several approaches to be effective, and disclosure is only one dimension. There's a lot of evidence that retail investors have generally a low level of financial literacy, and they lack the knowledge to understand the risk involved in the financial products. Secondly, the UK national regulator noted a few years ago that many advisors do not understand the risk in the product that they sell. Also, behavioral economic studies have demonstrated that investors are subject to cognitive and affective biases when making financial decisions. And in fact, their psychological attributes play a bigger role than information in financial capability. And by biases, we mean, for example, the tendency to be risk adverse, or to trust your advisor because he looks nice, etc. So all these factors are not rational, but it is demonstrated that they will influence your choices far more than any information document. Those are issues that are currently not addressed by the current proposal. I mean, you can have the clearest information document in the world. If people do not read it, or if they tend to rely more on the advice than on the information, then the document will not prevent them from purchasing the wrong product. And also, we would argue that some products, no matter how well explained, will always be too complex to be understood by retail investors. So we argue that if you want to effectively protect retail investors, you need to have a clear information document, you need to have unbiased advice, but you also need to have rules on the design of the product that limit excessive complexity in the packaging of the product. And in fact, several national regulators have already concluded from experience that these rules are necessary. The British regulator wrote a few years ago that focusing on the clarity of information and on the advice did not prevent several mis-selling scandals from happening. So we propose to introduce 4 simple rules that will limit the level of risk in the product, limit the complexity in the product packaging, and ban detrimental packaging features playing on the behavioral biases of investors. Typically, a product that offers a very attractive rate during the first years and then a conditional one plays on the fact that people focus on the immediate attractive return, and then they tend to forget about the subsequent risk, whereas it's just a packaging features. So some in the industry claim that such rules would prevent innovation and competition and prevent investors from being able to build long-term savings. Well, we find this argument very debatable for several reasons. First of all, these rules would still enable investors to invest in any of the traditional asset classes. They would not restrict the choice, but only ensure that the packaging is not overly complex and inappropriate. Secondly, similar rules already exist for UCITS investment funds that limit the level of risk. And these rules have proven not only to be effective, but also very popular with investors. In fact, UCITS funds are a commercial success precisely because investors value a sound and safe framework. Thirdly, interestingly enough, in my previous life, I used to sell derivative products to hedge funds. And hedge funds, we have to remember, are meant to be the most sophisticated investors. But what I find is that they very rarely bought structured products because they knew that these products were more costly, less liquid, and did not offer better returns on average. So really, how likely is it that retail investors would feel too constrained with simple products that are sufficient for sophisticated professionals? And finally, let me quote a recent report from a regulator saying that we still want to see innovation, but only where it is in the interest of the consumer. So it is essentially, in our view, to introduce product design rules in addition to improving information if we want to effectively protect retail investors. On the design of the key information document itself, like I said, I will not go into all the details. We find the design generally pretty good, but we have a few concerns. I will just mention one of our key concerns here. Regarding the disclosure of the environmental, social, and corporate governance objectives, the proposal does not specify at all which principles or standards are to be used. And that is a problem because there is a multitude of principles of varying effectiveness and strictness. So if you don't specify, there is a risk that this becomes a meaningless box-ticking exercise and a form of greenwashing. So we propose that the European supervisory authorities define the principles to be used. On a related topic, we argue that some products are investments in that they contribute directly or indirectly to the stable funding of loans and companies, whereas some others are just bets that do not contribute to any funding. And we argue that this distinction should be disclosed early so that, again, investors can make informed choices. So where are we in the current debate? Well, as Mathieu mentioned, the European Commission released this proposal in July last year. The text is now in discussion within the European institutions, and we may have a final compromise text later this year. We strongly feel, again, that this proposal is an opportunity not to be missed to improve the protection of retail investors and to reduce the risk of mis-selling in the future, and therefore that we have to get it right this time. Thank you very much for attending this webinar. I will now attempt to answer some of your questions.
Let's start with the first question that we have from Eric. Some in the Parliament have proposed to tell consumers what they are really investing in. Do you support this idea, Frederic?
Yes, absolutely. I totally support this idea in the sense that even with the the proposed the key information document, if you have too many sentences, giving the objectives of investment and etc., that can be a bit confusing. And we think that there should be one or two very simple sentences describing what is the underlying view of the investor. For example, there could be a very simple sentence saying that an investor who purchases this product believes that, I don't know, the stock market will rise over the next 5 years and is really investing into this and this asset. We find that such a sentence, which would summarize, what the product is about, would be very useful for the retail investor.
Mm-hmm. Okay, then we have a question from Philip. Philip, is it right to say that the only stake of the PRIPs directive is to finalize the 2-page disclosure document?
But the original scope and purpose of the PRIPs regulation is to introduce this new 2-pager document. So the original dimension is about disclosure. It's about making information more intelligible. Now, as I explained earlier, our view is that the proposal should be or could be more ambitious, and that in addition to disclosure and information, it should also add some other dimensions, such as product design rules.
Here we have something similar to the first question. Stanislas asked, Stanislas asked us if there should be more disclosure on the ESG. What kind of companies does the fund really invest in?
Yeah, that relates to a point I mentioned earlier. We find that it's very good that the Commission proposes to disclose the environmental, social, and corporate governance objectives. But currently in the proposal, there's just one line and no details at all. So if you don't specify any further, then you have a risk that it's the industry who will define the standards. Everybody, different provider, different manufacturers may have different standards, so that could be very meaningless with a very negative impact on confidence again, and that's really not what we want. So it is essential for us that more details and more are given on the principles to be used for these ESG standards.
All right, thank you very much. Question by Stanislas. And now we have Carl. Carl is asking, You say UCITS are well protected. You think that risk diversification means that the fund must hold at least 3 investments?
Well, risk diversification is only one dimension of risk management. I mean, the common wisdom says that diversification is a useful way of reducing the risk in an investment. That works in most cases, but not really during the extreme crises as we have seen, because unfortunately during crises what happens is that all the investments become heavily correlated. But anyway, to answer the question, yes, diversification is important amongst other dimensions. I don't know whether I would mention 3, I mean a specific figure like 3 or not, probably not. But in the UCITS directive, you have also some other elements that are fundamental, such as limiting the leverage in the product, which is the level of risk. So I would look at it broadly. And yes, as a whole, there are some flaws. I mean, it's not perfect, but roughly speaking, yeah, the UCITS framework is pretty sound.
Mm-hmm. All right. New question here from Stephanie. You talked about product rules. Can you give an example of inappropriate features of products?
Well, an example, I mean, there are several of them. An example is the one I mentioned earlier about the teaser rates. Typically, you're proposed an investment where you have a fixed rate that is incredibly attractive the first years, and then you have a floating rate. And that is I mean, there's a lot of mis-selling that have been happening with these products, and that's really about the human factor. I mean, people focus on the attractive rate during the first years, and they forget about the risk that they will be taking later on. The problem is that this is really a packaging feature to incentivize you to purchase the product, but it's not very useful. And again, I mean, there's been so many mis-selling examples with such feature that it's not really good.
Mm-hmm. But to your point of view, should consumer invest in short sales or commodity speculation?
Well, what we advocate is mostly about limiting the complexity in the packaging. So the point is we don't want to restrain the choice of the retail investor. I mean, they still have the choice to invest into all the traditional asset classes, but we feel that the packaging sometimes is far too complex, and the reason for its complexity is just for the manufacturer to put a bigger margin in it. And so that's where we think something should be done. It's really in the packaging and not in restraining the choice.
Maybe a last one, because the time is running. Maybe we'll get a last one here. When you look at the Commission proposal, I mean, what do you think, to really make it short, is missing, and what is the key point that you would like to stress, maybe, to conclude this webinar?
Well, as I said, the Commission proposal is a good proposal. I mean, the design of the document has been thoroughly researched, and we find it's a good proposal. But if there's one thing missing, again, it's really that it's only about disclosure. It should not be only about disclosure. It should be also about intervening at the design phase of the product.